Top of your business.
This program presented by BT Financial Group, helping people prepare for their best financial future.
Welcome back. Well, many investors want the safety of a term deposit, but where do you go if the rates are just too low? David Bassanese will stick around for this discussion, and I'm now joined by Andrew Lockhart from Metrics Credit Partners. Gentlemen, thanks for joining us.
Thanks, Peter.
So everyone knows what a term deposit is. We don't have to go there, but let's go to an area that has become really popular, namely hybrids, and a lot of people have gone to term deposits to hybrids. What do you think of hybrids, Andrew?
Oh, I think it's cheap equity. When I look at the a convertible, a perpetual, unsecured, subordinated convertible note, in most other languages, that's equity. Yeah. And I guess from my perspective, when I look at where investors are allocating capital to hybrids, they're looking for more defensive yield producing assets, and unfortunately I think a hybrid just really provides more volatility and more equity-like exposure to an investor's portfolio.
Would you be afraid to invest in a hybrid?
It's not for me. I don't invest in hybrids.
But you're not saying you're afraid?
If I was going to buy something that looked like equity, I'd probably buy the equity.
Okay, right here. David, you've had a long history of working in bond markets and all that sort of stuff. What's your general view on hybrids?
Look, hybrids, it's not true that they're equity. It's not true that they're sort of bonds. I mean, they actually have a valid role along the risk-return spectrum. If you look at the yield...
You he's worked in the bond market. He's talking about that.
If you look at the yield they offer, it's not as great as what you get on bank shares, but the volatility of a hybrid in normal market conditions is significantly lower than bank shares. So when the market... If you look at an index of hybrids during the GFC, bank shares are off 50%. Hybrids at that time are off 25%, which is significant, but that was a moment in time where people actually thought CBA, Westpac could potentially go under or be insolvent. You know, there was panic. The sell-off in 2016...
I wasn't saying that, but go on.
Sell-off in 2016 when bank stocks are off 20-odd%, hybrids virtually didn't move because the solvency of banks was no longer in question. So basically... You know, what you're taking with a hybrid, if sure there's bank risk, if CBA or Westpac becomes insolvent, they'll get bailed in and hybrids become equity.
And that's the person's gamble, isn't it? They've got to believe in the institution.
Exactly.
And if so, the actual rate of interest is not bad. If you believe in the institution, you prepared to take that risk, and there's a risk. Yeah,
well, and what I would say is if you are prepared to take that risk and you think banks aren't going to go broke, but I want something that gives me decent yield, but I don't want the share market volatility associated with the bank shares, then hybrid have a legitimate role. They offer, on average, around about a 5% yield, so it's significantly better than cash and bonds, less than what you get from banks, but again, with less volatility. So in terms of that risk-return spectrum, they have a valid role within that curve, and you can choose to have some or not. And the other thing I would say about hybrids just quickly is, the other challenge for retail investors is it's a very complex market to know what's a good hybrid and what's a bad hybrid. So buying a managed fund of hybrids also makes sense, and there are some opportunities now available on the market where you can buy, a managed fund of hybrids and let someone else make that decision.
Yeah. Well, this discussion opens up to your interesting product. So tell us about your fund and what it actually does.
Sure. So, Peter, the fund we operate that's ASX listed is called the MCP Master Income Trust. MXT is the ticker code. We provide our investors with a diversified exposure to Australian corporate loans. So we lend to publicly listed and private companies. We lend to project and infrastructure borrowers. We provide funding to a range of property-related companies, so both development financing and also for REITs. And we provide acquisition finance predominantly for private equity firms. So what we're about is trying to provide our investors with a diversified exposure to true corporate fixed income in the Australian market. When we lend, these are private side transactions. So we lend on terms and conditions commensurate with the way in which a bank would lend, and we're looking to provide our investors with that direct exposure.
So in many ways, you're competing with the banks for the corporate borrower. And so if someone, for example, was keen to not be in the stock market, chasing the profits of a listed trading company, if you like, if they invested with you, they might, say, put what, 50 grand with you, and you'd pool that in a whole pile of money and then look around for corporate borrowers who want to go to develop some sort of project or whatever. That's basics.
That's
basics.
right. Most companies, when they go to borrow money, go to the banks, and it's a heavily bank-dominated market. So what we're providing our investors with is access to a bank-dominated market to lend to companies that are active in the Australian market in Australian dollars on terms and conditions and directly at the loan, providing a loan. So you can provide equity, or you can provide other ranges of get exposure to the asset class in different ways, but it's very difficult to get exposure to the asset class of direct private side loans because it's a bank-dominated market and the assets generally sit on bank balance sheets.
Okay, so it's a listed company. So how does someone get rewarded? Is it in the actual unit price? That...
It's a unit trust. So obviously when we lend, we charge the borrower fees and generate interest and income from that lending activity, and then that income flows through to our investors in the form of distributions. And so we target to provide our investors with the minimum return of the RBA cash rate plus 325 basis points, so 4.75% net in the hand after all fees and costs, with cash distributions paid to investors each month.
Okay, now it's the question I have to ask, given where we started. Compare your product to a hybrid.
Yeah, I would say, yeah.
He's going to put you on the risk curve somewhere.
That's fine. Look, it's not a deposit.
No,
it's certainly not a deposit. We're taking credit risk and we're providing a loan. But a hybrid is more equity-like, and it goes further down the risk spectrum. We're in between. So if you think about a company's capital structure, obviously equity is at the highest risk, most volatile asset class, seeking to drive an outperformance for investors. And then you've got the debt component, be it mezzanine, subordinated debt, senior secured. That should provide investors with a more stable exposure and an asset class. And when you provide it through a diversified pool of direct loans, we're providing our investors with a very stable underlying capital value. And because of the way in which loans are structured and the way in which the corporate insolvency framework works in Australia, we believe that we can provide our investors with a very low risk of capital loss. Now, hybrid is more equity-like in nature, more volatile. Yes, it might be an acceptable investment for people, but I don't think people are being paid for what is effectively an equity-like instrument. If we were going to structure a loan and provide funding, we provide it in a loan format where the borrower owes a debt obligation. We lend $1, we expect our borrower to pay us back that $1 together with interest and fees. When you invest in a hybrid, you're not necessarily guaranteed of a capital return at the end of it. You're expecting...
It often happens, but there's no guarantee.
Correct.
So David, what do you think of this product?
Look, again, it has a valid place to... I think in terms of, again, the risk-return spectrum, sorry to use the jargon, but it's a slightly lower yield than what... Like, we have a hybrids fund, for example, HBRD. You can buy it on the ASX, BetaShares Bank Hybrid Fund. That gives you a, after fees, 5.2% grossed up return. The thing about hybrids also is you get franking credits. So the gross return is just over 5%. So it's a little bit more than that fund, but the volatility, you get a little bit of capital volatility when there's a wobble in bank share prices. Hybrid prices do move around a little bit as well. But I mean, compared to bank shares, much less volatility. So I mean, all of these have legitimate places along the curve. And as I said, I don't agree. I don't think you should lump... hybrids are very different from bank equities. What you're basically... Sure, if banks go broke, hybrids are in trouble as well, but the probability of banks in Australia going broke is minuscule. What you're basically getting in terms of reduced risk with hybrids is less market volatility over time. So if you hold a hybrid for 3 years, you're going to be fairly confident what the capital... Certainly if you hold a diversified portfolio, say through the HBRD fund, you'd be fairly confident what that capital value would be at the end of 3 years, unlike with, say, bank shares.
So, Andrew, with yours, that was like your minimum expectation. The actual performance, what's the performance been like?
We listed on the 9th of October last year. We raised $516 million for that particular fund. We said we would deliver investors exposure to not less than 50 individual loans. We're exposed, investors are diversified across a portfolio greater than 70 loans. We said we'd deliver the minimum return being the RBA cash rate plus 325, and we've delivered on that. And we also said that distributions would be paid monthly, commencing in January, and we've delivered on that. So from our perspective, because it is a trust, if we outperform the minimum target return, then investors will receive that as straight income distributions.
Yeah.
It's not as though we're retaining any earnings inside the company.
Yeah. It's a very interesting product. Guys, thanks for joining us, and I look forward to watching the progress of hybrids and your interesting fund as well, Andrew.
Thanks,
that's the show for the night. Thanks for joining us. Of course, if you want to check out my thoughts each morning at the close of Wall Street and also with the trading day ahead, go to www.switzer.com.au. If you've got any questions for me or ones you'd like me to put to an expert, email me moneytalks@switzer.com.au. You can follow me on Twitter and the handle is @Peter Switzer. And next week we'll see if stocks really can go higher this year, and we'll do that with prominent fund managers and technical analysts with a damn good track record of getting the market right. I'm Peter Switzer. Thanks for watching. I'll see you next week.